Okay, good afternoon, everyone, and welcome back to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're going to be talking about how to profit using options in bullish, bearish, and even neutral markets. This webinar is really, from my perspective, a review of the flexibility of options and the different options that it provides you with, pun intended, because there is a lot of flexibility in terms of how you can utilize options, whether you're using them to speculate on a specific direction or you're trying to generate income, and whether, regardless of whether you're bullish, bearish, or even neutral on a particular stock, there is an option strategy for you to trade. But today what we're going to talk about is more on the beginner side. We're going to talk about how to utilize options to speculate in these markets with limited risk. All the strategy we're going to talk about here are relatively beginner strategies. We're only going to talk about simple option strategies, buying calls and puts, selling cover calls. And what we're really going to try to do is make sure you understand the difference between trading a stock and trading an option with each one of these three strategies. So we're going to compare buying that stock, shorting that stock, to different option strategies, and why in certain scenarios you may want to utilize the option strategy. And if you do, make sure that you understand what is the fundamental difference between trading an option versus trading a stock. And what we'll do is we'll go over the best practices for each one of those strategies. We'll talk about what are the best starting points in terms of picking your expiration dates and strike prices, and then demonstrate as many examples of this using options play with real stocks, with real examples, so that you can really understand how to not only understand the strategies, but more importantly, understand how to actually implement them on different stocks or ETFs that you have a bullish, bearish, or even neutral view on. So my name is Tony Zhang. I'm the chief strategist here at Options Play. I really want to spend as much time today talking to you guys about the difference between options and stocks. So let's go ahead and get started. For those of you that are brand new to Options Play, welcome. What we're going to do here is the format is going to be about 20 minutes using the slides, going through the best practices and showing you these types of strategies. And then the last 20 minutes actually showing you the tools so that you understand not only the methodologies, but also how to implement them. If you don't already have access to Options Play, you can sign up for a free trial using the link here on your screen. And I just posted that into the chat window. That membership is $75 or $50, $75 a month or $500 a year. And for those of you that are starting out, or even for those of you that are already members, you can sign up for using that link to get a free 12-step options trading course to help jumpstart your options education. And lastly, included with your membership is daily options trading ideas sent to your inbox every single morning. So let's take a look at what we're going to go over here today. First, I want to talk about understanding stocks versus options, because there are huge differences between trading stocks and options. It's really just important to understand what those differences are, because that will help set up everything that we're going to talk about here today. Then we'll talk about the three basic strategies: buying a call option, buying a put option, and selling cover calls. That covers the bullish, bearish, and neutral markets outlooks that you may have on an underlying stock. And in order to truly understand how these strategies perform in terms of what is your risk and what is your potential reward, we have to look at the Greeks. And I'm going to explain the Greeks in the simplest terms as possible, and really, more importantly, show you how we utilize the Greeks so that you don't have to learn the math, you don't have to do the calculations yourself. We do all the calculations for you. And then lastly, what I want to do is I want to cover what are the common mistakes people make when they trade these different option strategies, so that we can hopefully help you avoid making those similar mistakes. And then lastly, we'll jump over to Options Play, and we'll just try to go through as many examples as possible and show you how to utilize these strategies to trade individual stocks or ETFs. So to start off, let's first talk about the difference between trading stocks and options. So when we're trading stocks, the reason that most people like to trade stocks is because it's really simple to understand. However, what that also means is that you're somewhat limited in terms of what you can do when you're trading a stock, because the only exposure you have with stock is simply in the sense for direction, meaning you can either go long a stock or short a stock. And that gives you either bullish or bearish exposure in that underlying stock. Now, there's a few issues with this from the perspective of once you take that exposure, you are exposed on both sides and you have dollar for dollar exposure, versus when you trade options, you have a lot more complexity, but with that complexity gives you a lot of flexibility. So instead of just being limited to being long short, you can get exposure to many different things. Not only can you get exposure to the direction, you can get exposure to certain amounts of magnitude, and more importantly, you can be very specific on your timing. And so what this means is that instead of just being long or short a stock, you have the ability to either buy or sell, a call or a put. So all of a sudden now you have, instead of being long short the stock, you have long or short a call or a put. And sometimes this can get a little confusing. We're going to review this in the next slide to make sure everyone understands the difference between buying a call to selling a call and buying a put and selling a put. So you can decide your direction based on buying a call or selling a put. You can then choose the magnitude that you expect a specific move to be by selecting different strike prices. And lastly, as far as timing goes, that comes down to selecting expiration dates. So we're going to talk about all of these things today here during our course to give you a better understanding as to how to actually choose the strategy, choose the expiration date, and ultimately choose the strike price. So with that, I think the first thing to do is just review the strategies themselves. So when we're talking about basic option strategies, usually the first one we talk about is selling covered calls. And the reason this is the first strategy we talk about is because when you apply for an options account at your broker, this is the first strategy that you are approved for trading. So when you sell a call option or selling a covered call, what you're doing is you're selling a call against the stock that you own in your account. And when you sell a stock, a covered call, effectively what you're doing is placing an order to sell your stock at a higher price sometime in the future. And this requires you to have at least 100 shares in order to sell one call option against the stocks that you own. So the general rule of thumb here is you want to sell roughly about a call option that's about 1 month out. So we talked about different expiration dates. And when you're selling any type of options, selling a call option that's about 1 month out is usually a good starting point. And you always want to sell an at-the-money call. I'm sorry, an out-of-the-money call. So what that means is that if you have a stock that's currently trading around, let's say, $100. Let's say you have a call that's currently trading around, a stock that's currently trading around $100. So if you own this stock, you obviously believe that it's going to go higher. So when you're selling a call option, you always want to sell a call option that's higher than the current price. So maybe that price is maybe, let's say, a 110 strike price. Because if you own a $100 stock, you obviously want to sell it at a higher price to make a profit. So whenever you're selling a covered call, you always want to sell an out-of-the-money call, a call that's higher than the current price, which allows you to take profit as the stock rallies or as the stock rises. So that's the general rule of thumb when you're thinking about covered calls, or the best way to think about covered calls is think about the current stock price and the fact that you want to sell that stock at a higher price. That's what selling a covered call effectively does, is you're placing an order to sell your stock at a higher price sometime in the future. Conversely, if you are using options to speculate, this is really where you have a bullish or bearish view on an underlying stock. So we can actually take that same example. We have stock trading at $100. We either believe the stock is going to go higher or we believe the stock is going to go lower. And depending on whether you think the stock is going to rise or you believe the stock is going to fall, that's where you want to decide between buying a call option or versus a put option. So a call option is going to be a bullish strategy. And the key here about buying a call option is that it's a bullish strategy with limited risk. And this is a key difference between buying a call option versus buying a stock. Because when you buy a stock at $100 a share, you are risking $100 a share. When you buy a call option, at 100 with a strike price, whatever you pay for that call option, that's all you can risk. And many times that is a very small fraction of the $100 a share that would cost you to buy 100 shares of that stock. Conversely, if you were bearish on the specific stock, that's when you would buy a put option. A put option is a bearish strategy with limited risk. And the rule of thumb with these two strategies is you want to generally buy about 1 to 2 months out in terms of an expiration date. You generally actually want to skew about 1.5 to 2 months out as a general starting point. And you want to start with in the money strikes. So unlike selling a call option where you want to sell a call that's higher than the current price, when you buy a call option, you want to buy an at the money or in the money strike price. So if you're buying a call option, let's see if I can erase this. 1 second. So if we're trying to buy a call option, what you want to buy is maybe a $98 call that gives you upside. And if, let's say, you were buying a put, you would buy maybe a 102 put that gives you downside gains to the downside. So we're going to come back to these two strategies as far as what are best practices, but that's just a quick review of the different strategies that you can deploy using options. And these are the most basic option strategies. We do cover more advanced strategies on some of the webinars we're going to cover this month. So if you want to learn more about trading vertical spreads and things like that, make sure you join us for our webinars over the next couple of weeks as we cover those more advanced strategies. Today, we're just going to talk about simple buying calls and puts and selling cover calls. So with respect to options, because we've added a little bit of complexity, you can buy or sell a call or a put. Sometimes it gets confusing as far as what's bullish, what's bearish, what is my actual outlook for all of these different strategies. So one of the easy ways that I've learned to make sense of all of this is to simply assign signs to each one of the actions. So you can either buy or sell. So what I've assigned is either a positive or a negative sign to buy or sell. So buys are positive, sells are negative. I think that's pretty self-explanatory. And calls will have a positive sign and puts will have a negative sign, because calls are bullish, so they have a positive sign. Puts are bearish, so they have a negative sign. And to remember what the different actions are and whether you're trading a bullish or bearish strategy, all we have to do is basic multiplication. So if we're buying a call, that's positive and a positive, which brings us to a bullish strategy. If we're selling a call, conversely, that's a negative and a positive. So that gives us a bearish strategy, because a negative and a positive gives us negative. Buying a put, which is again a positive and a negative, also gives us a bearish trade. And lastly, when we sell a put, which is a negative and a negative, that gives us a bullish trade. So that's one of the quick ways that I've learned to remember the different actions and what they actually mean in terms of direction. So next time you get confused about what selling a call is or what selling a put is, you can just remember, look at the signs and multiply them together, and that will tell you whether you're trading a bullish or bearish strategy. So let's go ahead and move on. So what I really want to talk about is first covering what does a stock trade look like, because once we have that set up, we can then compare that to buying a call option or buying a put option. So when we talk about buying a stock or short selling a stock, we're really talking about a strategy that's really simple, that gives us what we consider symmetrical exposure and immediate gains if we're correct in the direction. Meaning, if the stock is trading at, in this particular case, this is Apple stock at the time, is trading around 189. Basically, if you're buying that stock, as soon as that stock goes up even by a penny, you'll start making money. If you're shorting that stock, as soon as that stock moves down by a penny, you'll start making money. So this is what we consider immediate gains if the direction that you call is correct. And it also has what we call symmetrical exposure. What that means is that if you buy a stock and the stock goes up by $1, you make $1. But on the same token, if that stock goes down by $1, you lose exactly the same amount. You lose $1. So it's easy to calculate your risk. If the stock goes up 10 bucks, you make 10 bucks. If the stock goes down 10 bucks, you lose 10 bucks. So it's really easy to calculate your risk many times when you're trading a stock. And this trade allows you to hold on to that trade for any time horizon. So once you buy a stock, you can hold on to it for a minute, a year, a decade, however long or however short you like. There's no limitations. But lastly, I think the limitations of some of this is the fact that if I felt that Apple stock was just going to stay around the current price, it didn't really have a strong bullish catalyst or a bearish catalyst. Maybe the earnings announcement just came out and I don't really expect a lot of movement here. There's nothing you can do with your trading if you're trading the stock. If you simply thought the stock was not going to move, you would simply move on to the next stock and try to find opportunity somewhere else. And that's really where options comes into play, because you have options for all of these different scenarios, and you don't necessarily have to lock yourself in to just having symmetrical exposure. And usually, in my opinion, that's really the most attractive feature of trading options, is the fact that you can trade on leverage and you can trade with limited risk, so that if you're wrong, you only have a certain amount of money that you have at risk. So when we're talking about options, we're talking about the first scenario we'll talk about is we're bullish on a stock. So same stock, Apple XYZ, same stock, Apple, trading around 189. If I'm bullish on Apple, when you buy a call option, the difference between buying a call option and buying a stock is the fact that when you buy a call option, you only actually have profits if the direction and the magnitude moves higher than the premium that you pay for that call option. So unlike when you buy the stock, if the stock goes up by a penny, you start making money. When you buy a call option, whatever you pay for that call option, the stock needs to move by that amount before you make money on the call option. And that sometimes is somewhat counterintuitive. So for example, or actually, instead of giving you an example, I'm going to give you an example on the next slide. What I really want to talk about is the fact that when you trade, however, the flip side to that is that if the stock was to drop, you have limited risk, because whatever you pay for that call option, that's the most you will lose. Unlike if you buy an Apple stock at 189, if the stock goes down to zero, you lose $189 a share. That's a lot to risk, especially if you think the stock's going to go up to, let's say, 200 or 210. And lastly, option strategies only give you exposure until the expiration date. So unlike a stock where you can maintain exposure for as long as you want, when you buy a call option, it's only good until the actual expiration date. So I think the best way to really understand this is looking at an example. So let's say I buy an Apple call option for $5. What that means is that, or a 1 month call option for $5. What that means is that even though I'm bullish on Apple and I think it's going to go higher, I'm actually not just saying that I think it's going to go higher. When I buy that call option, I'm basically saying I believe Apple is going to go up by $5 or more in order for it to be worth my while to buy this call option. Because the $5 that you pay for that call option, that's the amount that the stock needs to move in before the strategy is profitable. So you actually need to move greater than $5 in order for your strategy to be profitable. So many times, it's not enough just to say I'm bullish on Apple. You have to say I'm bullish by quite a bit. I expect Apple to move up by more than $5 between now and 1 month from now for me to pay the $5 for the call option. So that's one thing that I think many times is a little counterintuitive, because you can actually call the direction on Apple correctly. So the stock can go from 192 to, let's say, 195, and you would actually still lose money on the call option, because you've paid $5 and you expect the stock to move $7, but when the stock only moves $3 in your favor, you actually lose money on the trade. And that sometimes, again, I find is counterintuitive for some users that are new to options trading, because you think, hey, I bought a call option, that allows me to take advantage if the stock goes higher. The stock went higher by a little bit and I still lost money. Why? And the answer is because you have to overcome the cost of the call option first before you make any of your money. So when you ask yourself next time you're thinking about buying a call option, you have to look at the price of that call option and factor that into how bullish are you on the underlying stock. But, and sometimes users will say, well, why would I want to do that when I can buy the stock? And the answer is the fact that because when you buy a call option, your risk is completely limited to the $5 that you pay. So when I buy a stock at 192, this stock can easily go back down to 170 and I would lose $22 a share. Here, if the stock pulls back to 170, I only lose $5 a share. So that's the limited risk factor that you get when you buy a call option. That's the flip side, if you will, of the fact that the stock needs to move a substantial amount to the upside before you make any profits. But to the downside, you've really capped your risk. And that's the goal of trading options, is to give you asymmetrical risk so that you can participate in the upside. So if the stock rallies up from 192 to 220, then you continue to participate in unlimited upside. However, to the downside, you have limited risk. So no matter what happens, even if the stock plummets to 150, your risk is still only limited to these $5. So you still have cap losses to the downside, but you have unlimited gains to the upside. And that's the goal of buying a call option. But again, you only maintain this risk to reward ratio until expiration. So that is just a quick recap of what buying a call option is and how that differs from buying going long a stock. Conversely, buying a put, same thing. You need the move not only in the direction that you expected to, but a magnitude lower by the premium that you pay for the put option. This gives you also limited risk if the stock was to rise, and this is substantially better, in my opinion, than shorting a stock, because when you short a stock, you truly have unlimited risk. When you buy a put, the risk is limited to how much you pay for that put, and you maintain exposure until expiration. So in that same example, if I buy a 1-month put at $192 for $5, now Apple stock needs to move down to 187 before my strategy is profitable. Because of the $5 I pay for the call option, the put option, minus the strike price, gives me a break-even price of 187. However, again, the upside to this is the fact that I'm now controlling 100 shares of Apple stock for only $5, and I'm only risking $5 a share to potentially make. So let's say in this particular example, if the stock does plummet from 192 down to 170, then what I'm going to make is $22 a share minus the $5 I pay. So I make $17 a share in gains while only risking $5 a share. And those are the types of risk to reward ratios that you get from buying a put option versus shorting that stock, because shorting that stock gives you symmetrical exposure to both sides. And lastly, you maintain this exposure until expiration. So lastly, what I want to talk about is selling a cover call. So imagine you have Apple stock. You don't think it's really going to move much higher. You don't know if it's going to move much lower. You think it's going to stay somewhere around where it is. So one of the best ways to trade this is to sell a call option, is to basically collect some income, and as long as the stock doesn't move substantially, so let's say the stock is just around 192 again, and you don't think the stock's going to move much higher, you don't think it's going to move much lower, maybe you think it'll move higher a little or maybe move lower a little, something along the lines of this, then what you want to do is you want to sell a call option, because that allows you to effectively sell your stock at a higher price, but at the same time allow you to generate income. And you can do this over and over again. As long as you have a neutral view on a stock, you can continuously collect income on a stock that's really not moving anywhere. And that income can go and help offset any losses you may have in the underlying stock. It can also help you generate an income stream, which will lower the volatility of any stock portfolio. So those are some of the ways that you can utilize option strategies to help you generate income. So let's say you own Apple stock. Let's say you purchased this stock at 170. It's now trading at 192. You're not particularly bullish on the stock. You think it may rally in the future, but for now, you think it's just going to move sideways. But you have a target price of maybe $200. What you can do is you can sell that 1 month $200 call, and let's say you collect $2 by selling that call. What happens is you have effectively two outcomes at expiration. Either the stock's above 200 or the stock's below 200. If the stock stays below $200, what you do is you keep the $2 income that you've sold that Apple call on, and you rinse and repeat. If the stock goes above $200 at expiration, you've now taken profit on your stock. So basically you make the difference between 170 and 200, which is $30 a share, plus the $32 plus the $2 in income that you received. So your total gains here on the stock would be $32 a share. And that allows you to increase your returns on your stock, because if you just sold your stock at 200, you would only make $30. Now you've made $32. And if the stock doesn't go above $200, you've now reduced your cost basis on the stock from 170 down to 168. You can sell another cover call, and you can continuously do this and continuously lower your cost basis on the underlying stock until the stock does get sold off. And at that point, not only have you lowered your cost basis by a bit, but you also increase your returns on the underlying stock as well. So those are the benefits of how you can utilize options to generate income on your portfolio and increase the risk to reward ratio, or increase the risk adjusted returns on the stocks that you already own in your portfolio. So in order to truly understand how these option prices change, we talked about option prices at expiration, but many times if the stock makes a move prior to expiration, how do you get a sense for how much money do you make or lose on a specific trade? With an option, the pricing of an option has in my opinion, two very important metrics that affect the price of an option, and that's delta and theta. So delta refers to how much the price of the option will change with respect to a change in the underlying stock price. So in the example before, when we talked about a stock that's trading around $100, let's say you buy that call option and you think the stock's going to go higher. And let's say you paid $5 for that call option, which means that the stock needs to move to 105 by expiration in order for you to break even on that specific trade. But what if the stock moves up to 103 with just 2 weeks in 2 weeks time? How much money do you make on that option? And that's what delta tells you. Delta gives you an idea as far as how much does the price in the option change with respect to the change in the stock price. So if you see a call option or any option with a delta of 0.5, what that's telling you is that for every $1 the stock moves, the option will move 50 cents. So in this particular case, if the stock moved $3 higher, the option would move roughly $1.50. That gives you a sense for how much money you can expect to make on an option trade if the stock was to move higher or lower. And that's that's the largest risk that you have with any option strategy, is the change in the underlying stock price. However, there's a second factor involved when you're trading options that may not be in play when you're trading the stocks, and that's theta. Theta tells you the decrease in the value of the call option or any option that you trade as it approaches expiration. So when we talk about buying a call option for $5, if the stock stays exactly where it is, that call option will actually erode in value as you get closer and closer to expiration. Whoops. So as you get closer and closer to expiration, that contract will erode in value. And the speed at which the erosion happens is what we call time decay, or theta. And theta measures the change in the option price with respect to time. So as time gets closer and closer to expiration, the value of your option will decrease in value. And theta measures the speed at which that decrease in value happens. So when we talk about a theta of 0.5, that's telling you that the option price will lose roughly 5 cents a day. So when we talked about the call option that you bought for $5, if the stock doesn't move, that option will start to lose money, will start to lose value. So what you need is the stock to move in the direction that you expect it to overcome the time decay, or theta, in the underlying option in order to make money from that strategy. So those are the key metrics that you really have to pay attention to when you're trading options that affect your option price. So lastly, let's talk about some of the common mistakes that some users make when they're trading options as beginners, to hopefully help you avoid making some of the similar mistakes. So first, let's talk about buying options. So this is referring to buying calls and puts. First of all, one of the common mistakes that people make is that they hold these trades until expiration. So you buy a 1-month call, you simply hold that call until the expiration date. You generally don't want to do that when you're buying options. Whenever you're buying an option, you want to buy that call or put, and you want to sell that call or put prior to that expiration date. And keep in mind, you can always sell any option prior to its expiration date. You can close any options trade prior to the expiration date. You don't have to wait till expiration for you to do something. So when you're buying options, because of that time decay, you don't want that time to decay to affect the option price too much. And the best way to negate that is to sell off your call or put prior to expiration. The second mistake we typically see users make when they're buying calls or puts is they use expirations that are too short. Usually this is less than 2 to 3 weeks out. Whenever you're buying options, you want to buy yourself some extra time. You don't want to buy just 2 to 3 weeks worth of time, because many times the stock may take a little bit more time to move than you expect it to. If you buy an expiration that's too short, number one, time decay is going to be a bigger factor on those shorter dated options, but also you're just many times not giving yourself enough time. So give yourself more time, go out 1 to 2 months out whenever you're buying options. Conversely, when you're selling options, this is really where many times we see users selling cover calls that are too close to the current price. So in the example before, when we talked about if you have a stock that's trading at $100, we were talking about when you're selling cover calls, you want to sell a cover call that's above the current price. So whether you're going to sell, let's say, a 105, a 110, or maybe a 115 call, we generally will tell you that when you're selling cover calls, you want to stick to these higher strike prices. You don't want one of these really low strike prices, because one of the reasons that we see a lot of users pick these really low strike prices is the fact that you're going to get more income on those lower strike prices. So a lot of people tend to gravitate towards selling cover calls that have more income. But that usually is a mistake to make. You want to sell cover calls that are relatively far away. I don't have quite enough time to cover all the reasons as to why that's the case, but we do cover that in detail on our cover call webinars. And the last webinar that I have for this month, which is enhancing option strategy, enhancing your equity positions using options, I will get into a lot of those details. So I do recommend you to come and visit us during that webinar if you're interested in more about selling cover calls. Next, along the same lines, because users always try to find more income when you're selling cover calls, we see that a lot of them are using expirations that are too long, because when you go out further in time, you're going to get more income. But that's usually a fallacy, because you can get more income by actually selling shorter dated options, but doing it more frequently than selling longer dated options. And lastly, whenever you're selling any type of options, you generally want to avoid them going into earnings. So make sure that you check to see if there's earnings coming up before you go ahead and sell any type of options. So with that, what I want to do is I want to jump over to options play. I want to show you some live examples to give you a sense for how to utilize our tools to find some ideas, and more importantly, look at buying some calls or puts. So I think this particular webinar is a little timely, because if you look at in the markets today, we've had a bit of a sell-off on more news about tariffs. The markets are just below that 295 level again, which was a key support level that we cracked above here in the beginning of July. Looks like we're starting to break below that. I would like to see how the market plays tomorrow, whether we bounce higher off that 295 or if we break lower. If we do break lower, I think there are some potential moves to the downside, especially in some of the stocks that are sensitive to these trade wars. So one of the things that we do is we use our watch list functionality. We look at certain sectors. I always look at the sectors to see where are the weakest sectors, where are the strongest sectors. I think consumer discretionary is one of those relatively strong sectors that will take a hit if the trade wars do get worse. So, I was looking at some consumer discretionary names here in our watch list. Names like Foot Locker, Ralph Lauren. These are stocks that have quite a bit of exposure to China. Even Under Armour, Tiffany's, these types of names I think have some exposure. So if you look at these types of stocks, these are the stocks that you may have some opportunities to the downside. That's where we would consider buying a put option. So if we're looking at Foot Locker, which is trading at $39.34, if we're bearish on this specific stock, one thing we would do is we could potentially short the stock. But conversely, what we're suggesting is you should take a look at buying a put option, because put options give you the ability to take that bearish exposure, but with limited risk. So let's take a look at short selling the stock versus buying a put option. So if the stock, which is currently at $39, obviously, I think to the downside, if you look at Nike, if you look at some of the other names, we've seen some move to the downside. Nike was down, I think, 4 or 5% today. So what we want to do is we want to say, well, what happens if this stock drops, let's say to $35 by the September 13th expiration? If you had shorted the stock, you make a 9% return. If you bought the put option, you make a 28% return. So in this particular case, these trades don't look particularly attractive because, as you can see, buying that 39.5 put option cost me $350, which means that the stock needs to move down to $36 before the strategy is even broken even. So if the stock only moves down to $35, I'm really not making a whole lot. I'm only making $1 a share or $100. So this stock really needs to move substantially lower to like 33 or 32 before this strategy starts to make any real money. But as you can see, if the stock even moves to $32, I'm looking at 114% return on my $350 investment. Moreover, if the stock was to rally, we have seen some of these sneaker stocks rally, like Skechers. If it does rally on earnings, one of the things that we do see is that we have limited losses, and that's one of the key reasons why you want to buy puts, because even if the stock rallies, I only lose $350 versus if I shorted the stock, I lose $849. So this is really how you can utilize our tool to quickly type in any stock and immediately see what are your opportunities to take advantage of a bullish or bearish view on an underlying stock. So here in Ralph Lauren, trading at 98.62, I can short 100 shares of the stock, or I can buy a put option. Notice how expensive this put option is. It's $510, and that's why you have a relatively low options play score, because a $99 put that cost me $510 means that the break-even price on this stock is $93.90. So this stock would have to move roughly 5% lower just to break even. Now, granted, this stock moved 5% today, so a 5% move over the next 43 days may not be that big of a stretch, especially if things turn a little bit worse in the economy, in what we're currently seeing with the trade wars. If things get exacerbated a bit, I think a 5% move to the downside is not unreasonable. And so this is really where you can utilize this tool to look for opportunities in specific sectors that you think you have a thesis on, such as consumer discretionary taking a hit. Also, energy is also one of those sectors that have really taken a hit today. So a lot of these stocks down 5, 6, 9%. I certainly wouldn't short going into one of these big moves. I would certainly wait for a bit of a rally before I would start shorting. But these sell-offs may provide some opportunities to the upside, which we are seeing in some of these consumer staple stocks. We're long Campbell's Soup, which is up 2% today on a day that's down almost 1.5%. So there's lots of opportunities that you might still be able to find on the long side, in my opinion, in some consumer staple stocks. Look at General Mills, also still substantially higher, very strong. These defensive stocks tend to do better when things are looking shakier. So let's take a look at buying General Mills. So General Mills trading at $54, which means that if I bought 100 shares of this stock, I would have to put up $5,400 in capital, versus buying a call option, I only have to put up $292 in capital. So I can control 100 shares either with $5,400, or I can control 100 shares with $292. This is really where you can start comparing the two side by side. General Mills currently trading at $54. Even if this stock moves, makes a new 52-week high around $56, Notice how the returns actually, in my opinion, don't look particularly attractive, and that's really why the options play score here is relatively low. So buying 100 shares of that stock is $5,400. Buying that call option, $292. So as you can see, this stock, if it rallied back up to $56, would only make a $58 profit, which is a 19% return, versus only a 2.5% return on the stock, but still not particularly attractive. So the stock really needs to move a little higher before these numbers start making some more sense. So if the stock rallies up to 57, now I make a 54% return. So that is some of the things to really be aware of when you're buying a call option, is that you can be right on the direction and still lose money on the trade or not make much money on the trade, because when you buy a call option, you have to overcome the cost of the call option. The flip side to that, or the plus side to that, is the fact that if you're wrong, you have limited risk. So if the stock really plummets, right? Let's say some things get really bad and the stock plummets to $48, which is that last low. You know, look at this. This stock went from 53 to $48 within just a couple of trading sessions. And we had that same thing again from 53 back down to about 50 or so, and 48 or so within a single session. Could that happen to the downside again? Sure. If the stock was to plummet down to $48, if you had bought 100 shares of that stock, you'd be risking $664 versus only $292 on that call option. Yet you participate onto the upside if the stock does rally. And this is really the asymmetrical risk that you get with call options and put options that you simply don't get when you're buying a stock. And this is really what you can utilize this tool for, to get a sense for whatever directional view you have an underlying stock, to analyze buying the stock to buying a call. Because again, just buying the call option does not always make sense if you have a bullish view, because it not only does your view have to be bullish, it has to be bullish by quite a bit in order for it to be profitable. So it's really important to look at a tool like Options Play before you place your options trade, to say, well, how far does the stock need to go before this strategy makes a reasonable amount of profit for me? Because if the outlook that I have on the underlying stock, so let's say Costco's at 275 right now. Let's say I think the stock's going to make a rally back up to its 52-week high. So I think it'll go up to 285. As you can see, if the stock rallies up to 285, I'm only making a 27% return. But I will say that if, let's say, it makes a rally back up to 285 a few days from now, so let's say by mid-August the stock rallies up to 285, now my return is 46%. So you have to ask yourself, you know, do I think the stock's going to rally? Do I think it's going to rally over the next week, the next month? Because those are the inputs that you can enter into Options Play, and we will calculate the delta and the Greeks and the delta and the theta for you to give you a sense for how much money can you make, and more importantly, how much money can you lose if the stock goes against you. And those are the inputs that you want to decide as to whether or not these option strategies make sense for you. And you can utilize our tools very, very quickly to type in any stock, quickly get a sense for your starting points for whether you're buying an option or if you're selling an option using the income tab, and we'll show you which cover calls make sense to sell on your stock. So if, let's say, you own 100 shares of Costco and you think that this stock has rallied significantly, you don't think it's going to move much higher, you think it might even pull back a little or just be somewhat neutral, that's when you want to sell a cover call. And Options Play not only gives you the cover call option, it also delivers to you the expiration date and strike price. So here it's telling me to sell the August 23rd 285 cover calls. It tells me how much income I will receive from that and the annualized return on that cover call. So here is a 7% yield on this cover call on a stock that only pays a 0.94% dividend. So if you own the stock, you're getting less than a 1% yield. You can add a 7% yield on top of that, which brings your total yield to 8%. Those are the types of bumps that you'll see in terms of yield by selling cover calls. And this is especially useful on stocks that don't pay a dividend. So if you have Facebook and this is a stock that you think maybe has near its peak. You think there's limited upside. You think maybe the stock's going to stay around this 192, 198 level. This is telling you to sell the August 23rd 205 cover calls, which will generate $120 in income. This is a yield of 10.3% on a stock that pays zero dividends. So if you own Facebook stock and you think the stock's going to stay where it is and you don't see a lot of capital appreciation to the upside, you can be earning 10% yield annually by selling cover calls, which will certainly offset, which will certainly bring down the cost basis of your stock a little bit, and allow you to generate some yield while the stock is trading sideways. And even if you own stocks that pay a very hefty dividend, like IBM, trading at 150, this stock has had a substantial move from 125 to 150. So maybe, especially near market tops where you think the market's maybe correcting lower, this is your ideal time to sell cover calls. Selling that August 23rd 157.5 cover call generates $47 in income, which is not a whole lot, but it is still 5% yield on a stock that already pays you a really hefty 4.3% dividend, which brings your 4.3 up to 9.5. So you can still double the dividend on a stock that is a very high dividend paying stock like IBM. And these are the types of opportunities that options provide you with that you don't get if you're just an equities trader. So the world of options is really vast. It really allows you to speculate with leverage, but also do it in a way with limited risk. And the best way to really understand as to whether it makes sense to use that leverage or use options is to put it side by side to buying that stock, comparing the two, using our P&L simulator to simulate how far do you think the stock will go, based on the time frame. So if you think it'll go up to 155 sometime by near the end of August, how much money do I actually make? You might actually find that many times that call option, even though the stock goes in your favor, does not quite provide the return that you're expecting to. In that particular case, you may actually choose not to trade the call option. And if that is the case, I feel that we have done our job in helping you, educate you, and making sure that you understand your potential risks and rewards before you get into a trade and not after. Because many times I hear from clients to say, hey, I bought these call options, the stock moved $5 in my favor, but I'm still, flat on the trade, or maybe I've lost a little bit of money on the trade. You don't want to figure that stuff out after you've gotten to that trade. Figure that stuff out before, and our tools are designed to help you do that so that you're educated before you get into that trade, and you already expect or you already know what to expect if the stock moves up $5 or $10 or $15. So you can see what those returns are, and more importantly, if the stock goes against you, how much money do you lose? So with that, that concludes what I wanted to show you guys here today. I just want to say thank you to everyone for taking the time out here this afternoon. I really hope that you guys have found this useful. At this point, what I'll do is I'll open this up for Q&A, and I'll put in the link again for those of you that do not have access to Options Play to be able to sign up, and also access the free 12-step options trading course for those of you that want to take advantage of that. So with that, what I'll do is I'll open this up for questions and answers. I know there was quite a few questions already asked during the session. So if you have questions, please type them into the chat window at the bottom of your screen, and I'll try to get to as many questions as I have time for here today. So Ram is asking, any presentations on exiting? So we actually covered this last week. We covered that presentation on rolling strategies and exiting multiple strategies. We covered cover calls, we covered calls and puts, we covered debit spreads, we even covered credit spread exits. So Ram, if you want to access that, I highly recommend you to take a look at our YouTube channel, which I will send a link to everyone here in just 1 second. You can view our YouTube channel, and we have all the links to our previously recorded webinars, including entering orders and managing positions, which is the one right here. And I will send everyone a link to that as well. So Ram, if you want to learn about exiting some strategies, we covered that in our webinar last week. Hi, Tony. If you have a poor man's cover call and the price of an underlying goes above your target price, what happens to the leap? Great question. So with the leap, this is where it gets a little trickier, because if you were to exercise the leap, you would lose out on all the extrinsic value of the leap. Unlike a stock where it just gets called away, you're okay. If you're selling a poor man's cover call, if the long leg still has a lot of time to go, sometimes you're better off just buying back the short call and selling another one, because you don't want to give up all the extrinsic value of the long leap, unless it's a really deep in the money leap and you don't have a lot of extrinsic value. Ram is saying, please define option price. It's just the price of the option. So when we say this option is $510, that's the price of the option. When you sell options, the strike price out of the money, when buying options out of the money, is it a reasonable assumption? When will you use at the money strikes? So when we're buying options, we always use at the money strikes. When we're selling options, we always sell out of the money strikes. And yes, buying options, you want to do longer expirations. Selling options, you want to use shorter expirations. That's a very good summary. Leaps greater than 6 months, is that reasonable? So most leap trades are, first of all, leaps refer to expirations that are at least 9 months out. So 6-month options certainly are long dated options, but they're technically not a leap. How would you select between buying calls versus selling puts and buying puts versus selling puts? So I think I covered that in my slide as to the difference between those. So if you want to learn more, I do have webinars just on selling cover calls and just on selling puts. But today we covered buying calls and buying puts. But if a stock goes substantially down, then what? When you have already sold cover calls. So in my opinion, selling a cover call doesn't protect you from the stocks moving substantially down. That's the same risk that you have when you own the stock. You have that risk when you bought the stock. So if the stock was to correct substantially lower, there's nothing in the world that's going to take away from that. But when you sold that cover call, you have a little bit of income that offsets the losses that you have in the underlying stock. So if you want to protect downside on the stock, you can certainly hedge that by buying puts, but that's a completely separate strategy. And I do have a webinar on hedging your portfolio against downside. So if you expect the markets to correct lower and you want to hold on to your stock, you can buy a put option to protect that trade. Joseph saying, thanks. Is this archived for re-listen? Yes, all of our webinars are recorded, and we'll send you an email about half an hour after we finish here today with how to go with the recording and the slides so that you can follow along at your own pace. David's saying, how does your program sort stocks by technicals? Yeah, so we sort it by what we call the score. The score is the technical score here. So the technical score gives you a sense for how strong a stock is. The 10s are the strongest stocks in the market, and 1s are the weakest stocks in the market. You can sort any of our pre-built watch lists, or you can create your own watch list and click on sort. And that will show you which stocks are strongest and which stocks are weakest. This is usually where I start my day, as I look at the sectors. And I look at what sectors are strongest, what sectors are weakest. So as you can see, healthcare, energy, and utilities are some of the weakest sectors. The strongest sectors are technology, financials, and industrials right now. So those are the ways to sort by technicals. Mitch is saying, can we use overbought, oversold signals to help us with our timing? If yes, please explain. Sure. So all of our trade ideas are based on technically oversold or overbought signals. So if you're looking for bearish opportunities, these are all relatively weak stocks that have that are currently overbought and generate a sell signal. And all of our bullish strategies are stocks that are strong stocks that have generated an oversold signal. So yes, absolutely. Or you're always free to add them onto your own charts. So, whoops. Sorry. If you wanted to add your own indicators to your charts, you can click on studies, whatever indicators that you like to use, and then you can add them or you can overlay them to your stock. So you can see here Goldman is relatively overbought, but as you can see, it's got strong score. 1 month and 6 month trend is bullish. I wouldn't short a stock that's bullish with strong strength, but those are the ways that you can use overbought and oversold signals. Rick is saying, how would you play an adjusted call option? J Nug had a 5-for-1 split. I have an $11 call expiring 8/16. It seems to have greater profit if I exercise the call. Rick, I'd have to look into that specifically for you. So if you want to send me an email at info@optionsplay.com, I'm happy to do so. I want to answer questions related to what we spoke about here today. Ro is asking, is call or put selling done at one standard deviation? How does the system choose? So when we're selling calls, we generally want to sell roughly one standard deviation out. When we're selling puts, we don't want to sell one standard deviation out. When we're selling puts, we actually want to sell puts that are relatively close to the current price. So notice how the probability of expiring worthless on this call is about 81%. That's close to that one standard deviation level. Selling this put only has a 69% chance of expiring worthless. So that's less than one standard deviation out. There's different reasons as to why we do that. But I will say, I do suggest that you come to our webinar, which I think is on the last day of this month, August, I think 31st, where we talk about enhancing stock positions with call and put selling. And I do talk in detail about what are the deltas that we choose for those specific strategies. But when you're selling calls, you go further out, about one standard deviations out. When you're selling puts, you go much closer than one standard deviation. Joseph is saying, as I have Chipotle stock, how would you play an option for this stock as well as Ross, Costco, and AVGO and Intuitive Surgical? So let's cover one of these. Let's look at Chipotle. Joseph, I'm presuming that you're bullish on Chipotle. So how would I play this? So Chipotle is at $790. Very, very expensive stock. So to buy 100 shares, you need $79,000. So instead of spending $79,000 to buy 100 shares, I can spend $3,140 to control the same notional value, which gives me upside and, more importantly, downside protection. So I don't know how far you think Chipotle can go, but it recently broke above the 720 resistance level, rallied up to about 810 or so. Recently pulled back slightly. Still very, very strong stock. As you can see, technical score of 10, 1 month and 6 month trend is bullish. This stock is, I would say, very highly valued at this point. So it is certainly very rich. So I certainly think that there's a lot of risk to downside, which is why it's even more important for me to buy a call option, which gives me limited risk. Because if I purchase the stock or if I purchase the call and this stock dips back down to, let's say, that 720 level, if I bought 100 shares of that stock, I'm risking $7,500. Buying this call option, I'm only risking $3,100. And this is a stock that if you purchased, you're purchasing it because you think there's still a lot of room to the upside. I don't know how much room there is to the upside, but let's say the stock rallies up to 860. As you can see here, if this stock rallies up to that 860 level, you make a 8% return on the stock or 122% return on the call option. Those are the types of returns that I'd be trying to shoot for if I'm buying a call option, while at the same time trying to protect myself. In the case the stock plummets, I'm only risking $3,100 as opposed to $6,000 or $7,000 when I bought 100 shares of that stock. So that's how I would evaluate this specific position. So the question you have to ask yourself is, how bullish am I on Chipotle? Do I think the stock will make at least a move to around 850? If you do think it'll make a move up to at least 850, I think buying this call option is attractive. If you think the stock's only going to move up to 815, 820, I certainly do not think that's worth taking your time. As you can see, even if the stock moves up to 815, which is a $25 move, you would actually still lose money on this trade. So you really require a big move to the upside, about 850 or so, before this really looks attractive. That's my opinion on that. So unfortunately, you threw out a lot of different ideas. I'll try to come back to that if I have some time, but I want to get to some other questions from some other users as well. So thank you, Joseph. David, how did you scan for the underlyings you want to trade? So I always start either in my trade ideas section or I start in watch list. I always start by sector. I always look at a top-down approach. I look at what sectors do I want to focus on. So, the theme of the market right now, or at least the reaction of the markets, is really to trade wars, right? The markets were up almost 1% and then sold off right in the afternoon when Trump announced another 10% tariffs on another $300 billion of goods. That tanked the market. So that certainly is the thesis right now. SPY is just below that 295 level. So the question is the sell-off going to continue tomorrow? Is the markets continue going to react to that? So that's my thesis, right? And I looked at sectors that really would be affected by this. So if you look at consumer discretionary stocks, that was one of the sectors that got hit the hardest. Financial stocks got hit because of the rate cut yesterday. Those are the sectors that I would pay attention to. And that's when I would drill down specifically into those specific sectors and look for some weak names if I'm bearish. So I would look for sectors, I would look for stocks with relatively low scores. So as you can see, MNT, Zions, Comerica, these are all stocks that got hit a lot today. So these are maybe a little late on it, but if you do think that things are going to get a lot worse, I think today's move is just the start of what could be much, much worse. If we were looking at Foot Locker before or Under Armour, these stocks move 5-6% to the downside. I think there's a lot of downside to some of these stocks. Lowe's, this is a stock that I think has quite a bit of exposure to the downside if things do turn. So if the stock moves down to, let's say, $91, as you can see, if this stock moves down to $91, buying a put option gives me a 95% return versus only an 8% return if I shorted the stock. And more importantly, if the stock does rally back up to that 108 or higher, I'm risking half as much as I would if I had shorted that stock. So not only do I get a substantially higher gain with that leverage that I get by buying a put, I also protect myself if that stock does rally. So those are the ways that I use this platform to scan for ideas. When I buy a naked put, what strike price do I use? So we always tell you to start with an at-the-money strike. So as you can see, Lowe's is trading at 99.49, so we've picked a 99.5 put. That's usually a good starting point whenever you're buying a put. Does your 12-step cover credit spreads? I don't believe so, but you can go to our YouTube channel where I do have a whole video on credit spreads, but it is one of the topics that we are going to cover this month, so make sure that you attend that webinar. But here is the link to the webinar on credit spreads if you want to learn more about it, but I am covering that in this month's webinars. Row is saying, where would I find IV rank for selling purposes? Higher IV equals higher premium. So Row, I have a whole thesis behind not just looking at IV when you're selling, because if you're only looking at IV when you're selling, you're likely not deploying your capital as effectively as possible. But if you're looking to sell cover calls, we do send out the cover call reports every single Monday. Where we do have the IV rank and IV percentile. This is where you can look at the IV ranks and percentiles based on the top 100 stocks in the S&P. John, how often do you update the information on a stock that you are studying? If the stock makes a major change, how soon does it reflect in the strategy? It reflects instantly. Everything is using up-to-date pricing. So all the information you see, the trend indicators, the option prices, those are all based on the current market. After buying call ID, stock goes down, how can we, after buying a call, if the stock goes down, how can we defend? I don't know that you would defend it. You would simply just sell the call option. So if you bought the call, so let's say we bought a call on Lowe's, let's say we paid $565 and the stock drops. The stock drops to, let's say, by mid-August, the stock drops to $96. So the stock goes down $3 halfway through. Now you've lost $418 on this trade. You would sell the stock and take a $418 loss. So you would lose $418 out of the $565 that you purchased. There's no way to defend it per se. You can simply just take a loss. Just like if you buy stock and it moves lower, what would you do? You sell it at a loss and you move on. Same thing with the call option. Ro is asking if a trade is open in options play, is it managed in portfolio? So the portfolio tool currently only tracks the daily plays that we're sending out to everyone. We are working on where we can pull in the positions from your portfolio so that we can actually show you your portfolio. As far as your end performance, that really depends on whether your broker is providing us with enough transactions for us to calculate that. Because we don't know when you close a position, we just know what your open positions are. So we wouldn't be able to give you year-end performance. Molly is saying timing to enter trades, most often third Friday of the month. You can enter a trade at any time, Molly. I don't believe you need to wait until the third Friday of every single month to enter a trade. If you are concerned about how to enter your trades, I highly recommend you to take a look at the recording that we sent out last week. We covered a lot about order entry. We talked about where to place your limit orders. We walked through all of those things last week. So Molly, please go to that YouTube channel. We have a whole YouTube video just on entering orders. I highly recommend you to take a look at that webinar. It's called Entering Option Orders and Managing Positions. So I really, really recommend you to view that if you're having some trouble getting your orders filled. Is your 12-step course and webinars in the YouTube the same or different? It's a little different from the perspective. It's organized in a way that really helps you step through from beginner to more advanced. So it is the same videos, but it's just organized in a way that's really meant to help you go from very beginning strategies or beginner topics to more advanced strategies. Mora is saying, where do I get information about high IV versus low IV for selling and buying options? I think I just explored that in the report. Stephen, how to play a cover call where the underlying has lost value? How to play a cover call. So I covered this in my cover call webinar. So I highly recommend you to take a look at that. But the general rule of thumb is that if you sold the cover call and you can buy it back now for 20 cents or less, or 20% or less than what you sold it for, that's when it's time to buy back that call and sell another one immediately. That's really the only thing you can do on a cover call where the stock has lost value. Eric's saying your portfolio / performance, where is that in your platform? So that's something that we publish. I will send, Eric, if you can send me an email at info@optionsplay.com, I can send you a link to that. What is your opinion of weekly trades? Obviously, there is more risk. I'm not sure what you mean by weekly trades. And I'm not sure what you mean by there's more risk in weekly trades. If you're referring to weekly options, we trade a lot of weekly options here at Options Play. From an options trading perspective, there's no difference between trading a weekly option and a monthly option. So there's no more or less risk in a weekly options than anything else. So if you don't mind clarifying, I'm happy to take a look. Do you list your entry dates? So every single trade that we list is on our blog. So you can go to optionsplay.com/blog and you can see all of the dates of when we enter and when we close out a trade. Oh, whoops. So it's optionsplay.com/dailyplay. So you can see all of their trades, and you can see the dates of when we enter these trades and the dates of when we exit these trades. So you can get all of that here using Options Play. Joseph is saying, for starters, what is the more safer system to get started with making a little weekly income and with more winners? By far, the safest place to start is selling cover calls. What is the link for the 12-step course? So the link is here. I will send into the chat window. Shalom is asking, any no commission brokers? Shalom, there's quite a lot of no commission brokers right now. First Trade, one of our partners, firsttrade.com is one of our partners that uses zero commissions. But there's lots of them out there now. Robinhood, Webull, you can just Google zero commission brokers. There's a lot of them out there now. But I can certainly point you to First Trade, one of our partners that have zero commission stocks and options trading that you can trade. Any other questions? When you sell a put and it gets exercised, do you lose the cost of selling the put? No. Whatever you sold the put originally for, you keep that even if it gets exercised. So if you sell a put for $2, you effectively get a $2 discount on the stock purchase that you purchased. Any tutorial on your optimal cover call report and how to use this report? Andy, I believe I covered that in my cover call webinar. So I definitely recommend you to take a look at that YouTube channel, and I do cover that there. Raymond, thank you so much. I really appreciate it. Thank you for taking the time. Same thing, Irina. Eric, do you have an auto trade program with one of your broker partners? So Eric, that is not something that we currently set up, but that is, we are talking to one potential partner that is currently in the process of doing that. There's just not a lot of auto trade programs that offer options trading. There is one being built right now that we are talking to, so potentially, but not at the moment. Any other questions before I sign off for today? Don is saying, knowing that 70 to 80% of options expire worthless and selling cover calls would be the best technique to make money. Don, that 70 to 80% statistic is a little flawed in how it's calculated, but yes, you know, overall selling options, let me put it this way. If you're only buying options in the long run, you will likely it's very difficult to make money. Meaning, whenever you're buying options, you should also be at the same time selling some options as well. So selling cover calls, selling cash secured puts. Even when you're buying calls or puts, you really should learn how to utilize debit spreads or credit spreads, and those are the two strategies we're going to cover in depth this month. We're going to dedicate a whole webinar to debit spreads. We're going to dedicate a whole webinar to credit spreads. I highly recommend that whenever you're trading options, there is some aspect of option selling built into your strategy, because that is how you're going to be able to make money in the long run. Joseph, Sue, Stephen, Jens, Wayne, thank you so much. Don, thank you so much. I really appreciate it. I hope you guys have found this useful. I hope you guys have a great week and month in trading. You know, August is always a little quiet and things usually turn, you know, seasonally. August is not a very strong month for the markets. So I hope everyone has a great month trading, and I will see you guys next week. Have a great evening.